All right. Okay, well, we're a minute short, but let's get this started. So hello and welcome to this panel discussion on digital lending hosted by Illiteracy and Sagis. This is the first in hopefully a series of events on digital lending, and this panel will focus today on disruption and change. So before I hand over to our panelists to introduce themselves, just a quick note on questions. If you have a question, please use the chat on YouTube. Feel free to drop in your questions as they come up so that we can get to them at the end. And you can also tweet using the hashtag digital lending. And you can also use kind of YouTube to say hi and where you're calling in from. Alrighty, so on to the introductions. Perhaps Stephen, you'd like to kick us off.
Sure, Theo, thanks. So my name's Stephen Brown. I've worked in the financial services space for the last 20 years. Started my first small mortgage brokerage in the early 2000s. So I think I actually predate regulation. For anyone who remembers the Mortgage Code Compliance Board, I actually go that far back. So I worked with a number of brokerage firms in the noughties, and then progressed to working with Clydesdale Bank in intermediary distribution from around 2010. And last year, I started with the Scottish Building Society as their current head of intermediary lending.
Barbara?
Hi, so I'm Barbara Collins. I'm head of change at Illiteracy. My background has been delivering change management for 20 years across the public sector, financial services, construction and retail. I like to focus on organisations that are undergoing transformational change and support them as they help their colleagues learn to work in a different way with different tools and different processes.
My name's Tim Hague. I'm the Managing Director of Sagis. I predate Stephen. I started in 1986 at the Derbyshire Building Society. It's far too long to remember. And I've been working in financial services ever since. So for the last 10 years, as a consultancy and interim management side, supporting lenders and savings providers to work on strategy, develop propositions and to transform systems, technology.
All right. So to kick off the panel, yes, so maybe we can start by kind of looking back. What are your reflections as a panel on 2020? Specifically, like what have we learned about how institutions can be resilient to change going forward? And yeah, maybe from a lender's perspective, Stephen, we can start with you.
Yeah, sure, no problem, Theo. So I think just to avoid being sort of wholly narcissistic, I'll maybe just I'll give a brief summary of sort of who the Scottish Building Society are, so that you've got an idea and it sets a little bit of context. So we're the oldest building society in the world. So we were founded back in 1848 off the back of what were called terminating societies. So these were societies that were set up for a sole purpose. That was to buy all of their members a house effectively. And then once the society had bought everyone a house, they were wound up. So actually, the Scottish owes its existence to one of those terminating societies that was founded in a pub in Birmingham, and that was way back in 1848. So it's a very, very old business, and we're what are termed a limited society. So quite a small business. We have 500 million in assets and about 70 staff. So I joined the society last March, and that was just 3 weeks before lockdown took effect. So I took over the role of head of intermediaries at that time, and essentially the big sales target for the society sits over my head. So it was very much a case of welcome on board. By the way, a global pandemic has just hit, the property market shutting down, and actually it looks very much like the end of the world out there. So it was a bit of a baptism of fire. But I think as a leadership team, we collected our thoughts and priority number one was just getting everyone safe. So we needed to make sure that everyone was safe, and we moved everyone to working from home. Pretty much 85% of the populace to working from home within the first 3 or 4 weeks of the pandemic hitting or the lockdown hitting. And that's in an environment where before that point, nobody had worked from home. So that's sort of priority one getting everyone safe. And then second to that is, can you operate effectively as a business, supporting your members and your brokers? So there's some considerations, things like virtual desktop technology. It might sound like something that's been around for a long time, but if you don't have virtual desktop technology, actually it's very difficult to move everyone to working from home. And we were fortunate that we had that. And from there, once you've got that, then actually you're then into buying physical hardware. So we bought a lot of laptops for everyone, just to make sure that, again, we could facilitate that safe working from home. And then you're into communication, so things like voice over IP telephony, which is critical, corporate Zoom licenses, Teams, supporting that communication. But I think, and just to round off, I think probably the most important thing that we discovered was actually keeping very close to both your staff, your members, and your brokers. So communication is absolutely key. So for our staff, they wanted support, they wanted to work from home, and they wanted that sort of flexible working arrangement. Our members wanted access to cash, safe access to cash, despite the significant lockdown measures. And our brokers, they just wanted us to remain in the market. And you may remember that a lot of lenders withdrew round about that time. So for us, we remained in for as long as was practically possible. So yeah, I think that that was our sort of true north, if you like, round about that sort of time, reflecting on the year that has gone by.
Nice. Tim, what about you? What are your reflections?
So I think what you saw was an interesting change in sort of internal cultures for lenders to start off with. So the large lenders were used to a lot of automation, and then all of a sudden they were sort of hit sideways with a whole load of things like payment deferrals and complex underwriting of furlough income and that sort of stuff, which they're not used to. So they had to rob a whole load of people from all over the business to try and step in to fill that gap. And as Steve says, they effectively pulled away from the market. So that left when you're talking about the big six lenders, that's a very big hole to fill. So I mean, it was good that the medium-sized and smaller lenders were able to step in and fill that space in the short term, whilst the big guys gathered themselves together. I think it'd be interesting to see, because a lot of those smaller societies aren't used to people working from home. Culturally, they don't like it, and therefore they've had to adjust quite significantly. And I think it'd be interesting to see what endures as the dust starts to settle down and things start to look like whatever the new normal will become. Because a lot of those processes that were put in place were done very rapidly. Banks and building societies are very cautious by nature, and therefore I think we'll need to go back and reflect on how resilient they are, what things they want to keep, what things they might want to improve from an efficiency perspective, and which bits they want to go back to how it was before.
Do you share some of those reflections as well, Barbara?
I think so, yes. And I think what's really interesting, and one of the things that Stephen just said about the three different targets, they've got the staff, the members and brokers. I think it's the same as individuals. We've all been through change as individuals and family members. We've all been through change as employees and also as customers. So I think in the beginning, there was a lot of patience with businesses. If you were a customer, there was a lot of patience with businesses as they started to transition. And I think now, looking forwards, it's around, is that patience going to start to run out, and are we starting to see dissatisfaction where people aren't getting the customer service maybe they were starting to expect that we used to have, but also recognizing that people have accepted now we work in a new way. So based on what we've learned over the last year or so, how does that reflect into our future and the way that customers want to be served? Because now we kind of expect that we can do everything online. So is there a shift in terms of how people want to engage with their suppliers or engage with their banks or their lending providers in a different way? And I think one of the other things that is really interesting, if we were listening to the history there of the Scottish Building Society and how much history you've got, and that's obviously, I would suspect, evident in the culture. You know, I'm sure people are really proud to work there. They're really keen to, you know, stay employed, and I'm sure they're really grateful for the focus that was on them as individuals rather than on the targets. And I think that culture drives a lot of the way that employees behave and how flexible they've been, and how focused they've been on being able to continue to support their customer no matter what barriers were put in their way. And I think that's really helped us understand the resilience that our staff has got, because we can really see that they'll do anything to keep the show on the road.
I think for sure that a lot of building societies are also reflecting on the reduced footfall in their branches. A lot of the people who visit the branches are tend to be older, and for obvious reasons they want to avoid going into branches at the moment to make contact with people. And so the traditional sort of branch footfall piece, I think, is now needed to be reviewed, and a lot of building societies are revisiting their digital online presence to see how they can support customers, but also remain relevant at a community level as well.
Nice, yeah, and I think kind of leading into my next question, which kind of has already been touched on a little bit, but what has really this kind of working remotely, and how has that kind of directly impacted the industry?
I think Barbara used a great word there, which is resilience. So to have resilience, you need to have your health first and foremost. So I think it's brought health and well-being front and centre, and that's both your physical health and your mental health. So as a team, we can't operate effectively unless we're healthy. You know, and the last 12 months have been incredibly challenging for a lot of people. There's time pressures around homeschooling, which is just something that no one has ever really experienced before. And in many instances at the other end of the spectrum, people are living in quite an isolated place. If there's no one else in, you know, that you're living with within your property and you're working from home, then it can actually create isolation, which is, you know, a form of vulnerability. So, you know, I think that really has been brought forward. And for us, I think as a business or a society, there are a number of considerations around this. I mean, I try to do something simple for my team. I don't use the word dogged very often, but I became pretty dogged when it comes to ensuring that my team get enough physical activity. They are literally sick hearing me say, get away from your desk at least once a day for at least an hour, and go for a walk, which is good for the soul. It's something simple that we can do and just brings a little bit of balance. But you know, I think there are other considerations as well, and it could be that connection is something that we need to have. So, you know, I think you need to be super disciplined around team meetings and team huddles, because there needs to be that constant connection with the team working in the field. I think you probably do need to look at workplace assessment. So the actual physical process of sitting at home, and there's a lot of people initially who are probably sitting at home on dining room chairs, which are just not fit for purpose. So I think there's potentially that aspect to it as well. And then there's the mental aspect to it. So giving your team coping mechanisms. So it could be something as simple as looking at the Headspace app, or potentially looking at MBSR, you know, mindfulness-based stress reduction, you know, bringing someone in who's an expert on that to talk to your team, and giving those sort of coping mechanisms. So I think for me, we probably as a business had to embrace the health and well-being and the changing environment that we've seen.
I think communication will be a recurring theme through a lot of this. When people are used to sitting next to each other in offices and passing pieces of paper around and following, actually it's a lot of processes, cases ping backwards and forwards all over the place, and that's just not practical when you're working remotely. So I think brokers talking to clients, brokers talking to lenders' internal teams talking to each other, I think has been problematic. I think, as I say, from a purely practical perspective, it's been quite challenging stepping through the process, and that process has therefore understandably become quite elongated. And I think back to Barbara's earlier point, I think customers have been fairly tolerant to a point, and I think it'll only be so long before they expect that people will have responded in some shape or form. Certainly the acceleration of technology that was implemented last year was very much taking existing technologies and putting it in place. I think what will need to now happen is looking at what are the things that make those differences, and play catch up on some of the stuff that's being impacted in the short term. And that then actually naturally brings on things like operational risk and fraud risk as well. So if brokers aren't physically sat with customers, how do we know who they are and that the documents that they've got are genuine documents from a fraud perspective? How do you make sure that all the processes you're following work and you don't find things falling through the cracks and so on? So I think there's some fairly far-reaching things which will take not 5 minutes to fix, and probably not completely this year either.
And I think I would have answered very similarly to that question. I think that when we first moved to working remotely, we did everything in the same way but at home. And now it's about, we will have some element of being at home for the foreseeable future. So how do we change our business processes to reflect that new way of working? And I think the second thing I would have said was, this has just demonstrated how important relationships are. Even if we move to more automated ways of working, relationships both on a personal level, so like Stephen was saying, from a well-being point of view, it's important to have people that you can talk to, but also from a broker relationship point of view, you know, we naturally do work with people that we like. So I think that working in a remote way, we're going to soon learn how to build relationships based in a digital way where you might never ever physically meet that person.
I think it might lead an interesting debate about the haves and the have-nots as well. I mean, I think we saw last year questions about pupils who were missing out on education because they didn't have a laptop. And therefore, if everybody goes down the digital route, are we excluding some customers just because they don't have access to certain lenders or certain deals? And the same thing actually for the institutions themselves. So the big guys have got lots of money and lots of resources to embrace this technology, and the smaller lenders will find it more difficult based on just the pure size of the business, and therefore how much money they've got available to invest in what are fairly expensive technologies. So I think that could drive some interesting changes around the shape of the market and which lenders play in which space, but also maybe potentially some increased collaboration. So lenders have historically been very bad at all agreeing on the same thing. I think they may have to, because otherwise they just won't have access to some of the technologies.
And don't always assume that the technology is expensive either. I think you made a great point earlier on, Tim, around like how can you tell two people are in a location at one time? Geolocation, it's not actually that expensive. Actually, depending on where you go for your solution, electronic signatures and EID and V isn't actually necessarily that expensive. But I think you're right. I think there are some aspects of it which, you know, the big banks will naturally be able to afford that the smaller lenders may struggle to afford.
And I think as well, the big banks or the big companies have probably done large scale transformation before, obviously not in the same domain, but they're going to have introduced new ways of working, they're going to have introduced new systems. So they've probably got some of that infrastructure already in place in terms of people with the skills, whereas some of the smaller organizations doing big change like this would be new to them. And, you know, it's not going to be successful if you just stick that activity on top of somebody who's already got a full-time job and hasn't done it before. You know, you're setting them up to fail to some degree. So I think that's another consideration as well.
I think the capacity for change is much greater in the larger organisations. I think they have different challenges because being larger, they tend to be far more sort of complex in terms of some of the changes and the layers of changes. I know one lender that should remain nameless, we were doing a systems upgrade and they had over 100 integrations on one core system. So it's not just the one piece of work you're doing, it's the spin-off onto everything else you're doing as well.
It's like a spider's web.
Alrighty. So let's move on then. So, I mean, we've seen from the pandemic that it's made kind of customers a lot more vulnerable, and there's kind of had a big impact on the underwriting processes. So as a panel, like, what are your thoughts on how we move away from some of these more complex manual processes in the future? Stephen, do you want to?
Yeah, sure. Yeah, absolutely. So I'll probably stick with the underwriting theme on this one. So I think when you're looking at underwriting, there's probably two parts to the question. So you're either looking to remove inefficiency for a human, or you're looking to automate. So if you're looking to automate, then what you're essentially talking about doing is building a decision engine, and then from there, it's how deep that decision engine goes. So can you make the decision engine match your credit appetite to client circumstances algorithm, and how refined is your decision engine? So that the challenge with this is the more refined the decision engine, the more labor intensive it is to upkeep. And that's a critical consideration for smaller lenders who have limited resources. So I think you probably can build a decision engine to mop up every eventuality. But if you're a lender that's seeking a narrow range of circumstances, then it's very easy. If you're seeking a really broad range of circumstances within that decision engine, then that's difficult to build. So I suppose in real life terms, for my sort of simple brain, if you were looking at someone who was a contractor, who had an element of light adverse, who was paid in Norwegian kroner, and who was looking for a guarantor loan, then it's going to be difficult to build that level of granularity into your decision engine the way that decision engines are created at the moment. So simple customer, easy to automate; complex customer, far more difficult. And I think we've sort of moved from the industrial age into the knowledge worker age. So we used to be paid for what we did, and we were paid for what we knew. And now I think we're potentially moving into the age of the decision maker. And the next stop, incidentally, in my opinion, is the age of AI, where ultimately AI will do everything better than a human, like literally everything. But we're probably about a decade at least away from that level of neural net impacting. And it's something that's quite interesting to look at other industries. So I think if you think sort of automated cars or self-driving cars, in that world, they've started to introduce neural nets. We don't see them so much in our world. I think when you start to see neural nets coming in to financial services, and I think that's when you'll start to see a sort of a seismic change in some of that decisioning.
I think it's interesting that some lenders are struggling with API technology at the moment. So I think we are a little way away yet. Certainly, I think the fact that large lenders automated everything and did a lot of plain vanilla lending, and the smaller lenders did a lot of manual underwriting of complex cases was almost like a happy accident along the way. But manual underwriting is quite normal. I think that the area that people are going to struggle with is just capacity, because I think there used to be lots and lots of plain vanilla borrowers who are now going to be complex just because of the experience they've been through over the last 12 months. So we know that the big six have had to bring a whole load of people in to cope with some of that complex underwriting. The question is, are they going to keep those people, and therefore want to pump more customers through that machine? And does that mean then that it becomes a far more competitive marketplace? Margins narrow. Some of the smaller lenders find it more difficult to make the money and actually pick up the volumes that they used to do. So that'd be interesting to see what the big six response will be. But I do think technology will, absolutely where Steve comes from, I think technology will help to automate processes, allow humans to focus on the key tasks that need to be done, and hopefully also bring some consistency. I mean, you hear repeatedly people can say that you put the same case through 6 different underwriters and you'll get 6 different answers, or 6 different sets of information that are required, and therefore technology can certainly help to deliver some consistency and certainty for brokers as well around decision making. The other area for me, which I think is one that is not been spoken about in the same way, is mentioned around pre-arrears and arrears. So as lenders filled the void left by the big 6 last year, I think there's growing concern now as redundancies start to hit, that you might see that follow through in pre-arrears and arrears cases. also some of the stuff that the government did around making sure that you can't evict tenants and that sort of stuff, that's going to come back and bite at some point in the future. So I don't think that in the same way that capacity in the origination side is going to be under stress, I think that there'll be some capacity challenges around pre-arrears and arrears handling as well. And also those systems haven't really been put to test in volumes and granularity. So they might need to be thinking about some more sensitive approaches to handling strategies to handle vulnerable customers, and trying to strike the right balance between the guidance that the regulator's giving, which is about treating these customers sensitively, and making sure that you are doing things in the best interest of customers, and that'll be an interesting one to square.
And you don't necessarily want to automate arrears and pre-arrears. That's not something that you want. There's going to be a high degree of empathy in that area. So that's certainly going to be something that will, for the foreseeable, will sit with a human. That's for sure.
And I think as well, it's around remembering the employee satisfaction as well. So they may have complex paper processes or manual processes today, and I'm sure the process that they suggestions how to automate, but I would also suspect that there's some parts of their job that gives them great joy, and that's the reason they do that job. And so in amongst all of this, it's remembering actually we have to keep satisfied, we have to keep our employees satisfied as much as our customers, and that we have to make sure that they really get value out of the work that they do and they feel that they're given value. And for some of those market lenders we talked about who help those that are outside of the normal, less vanilla than the bulk of the people, I'm sure they get great customer satisfaction. So I think that adds an interesting dynamic as well around how we're going to keep our employees engaged and satisfied as we move and change the ways and processes that we work on.
I think if you asked an underwriter what it is that they enjoy doing, they would probably say that making the decision, that it's kind of the bit in the middle of the process, and high quality decision making actually is perishable. So you'll see a lot of people at the top of their game. So for example, Barack Obama, he's a very limited palette in terms of how he dresses and what he has for breakfast, because he knows he only has so many good decisions in him in a day. So that's why he strips it right back. And I think underwriters as well, a lot of the other distractions around the edges, if you can lift them away and get them to doing what it is that they actually really enjoy, I think you're right, Barbara. It brings that satisfaction into the job.
The extra stuff can be simplified, automated, given to somebody else to enable them to do what it is they're really, really good at. That's really important. And I think that takes us back to the conversation we were just having around delivering change and changing things. Actually, those people will have great expertise in being able to give advice and recommendations, but it wouldn't be fair to give them any extra job of implementing it or writing process maps or any of that stuff that sits around it, because then you're eroding away, like you said, Stephen, at the stuff that they enjoy doing and they're really, really good at. So I think that's something to keep in mind. We definitely need to tap into the experience that they have, because they're the ones closest to the customer in the process, but remembering that everybody has a different skill and a different desire out of their day.
And that's a constant challenge, absolutely. Just having people who are doing the day job and trying to implement change off the side of the desk it's stressful enough at the best of times. But if you just pile on top of that, trying to hit the stamp duty deadlines and the additional complexity that they're being asked to look at the moment, that will just be soul destroying, I'm sure.
And going away for an hour every day for your walk to keep your mental health, which is absolutely critical. But I think that personally, for me, I think going back to question 1 around and 2 around working from home and our reflections, I think everyone's days just got longer. We don't have that commute time anymore to wind down. We don't have walking around, to the coffee shop with a colleague to have a chat and just to get stuff off your chest. All of that's gone. And I think because we're still trying to work in the same way with bigger complexities, more regulations, more risk, it's actually making everybody's jobs that little bit bigger. And that's one of the things that I think as we start to focus on the next couple of years, understanding how we can rebalance that so everybody can perform the best that they can.
Yeah, I think there's a collective nervousness about a return to normality. I think it's probably the thing that my team most frequently asks me. It's like, how are we going to go back into the field, given that the workload at the moment feels actually quite brisk? And I think it's probably building support around that and recognizing that quite possibly there may not be a return to the way that we've done things before. It might be a blended role, where there is some aspect of face-to-face, but it might have to be less to give someone a balance, I suppose, is the word that I'm looking for.
And some people will like that. I guess we always assume that brokers wanted face-to-face and valued face-to-face, and some of them will just like, for goodness sake, why do you keep turning up on my door? So some of them will be glad of a bit of peace and quiet. And I think balance is the right word, isn't it? It's making sure that you're being attentive to your customers, however they want you to interact with them, but making sure that you're still getting some human contact yourself.
Do you see much difference in the ages of the customers, in the way they want to interact? Because I imagine that the younger customers, maybe those that are looking for their first mortgage or have just started in their professions, I imagine that they are much more demanding to be served in a digital way than maybe those that are retired and a bit more towards the end of their careers. Have you seen much change in that, or a demand that's now more evident?
Yeah, I mean, I think from our perspective, we certainly have. Yeah, I think it's more likely. So I suppose if you use open banking as an example. So if you are 21, are you more likely to sign up and relinquish control of your bank details than perhaps someone who's, I mean, I'm 39, so am I less likely to embrace open banking? Yeah, I'm probably less likely to embrace it, if I'm honest. Is that potentially going to disadvantage me if I don't take advantage of open banking? Yeah. So yeah, I think it's just, there's probably quite a bit of education needs to go into that must sit behind the advances in technology that are coming on the roadmap over the next few years. I think that's a really good point, Barbara.
I think it's interesting as well, though, what nature of engagement they have. So next time buyers and people long in the tooth like me have been through that process a few times, and we know what to expect. And the first time buyers who've never been through that process are a bit more twitchy and nervous about what to expect. So I'm a member of my Spotted Measham Facebook group, and I'm constantly seeing young people asking, do they know? Could anybody recommend a really good mortgage broker, or what do I do here? So they're getting that information, but they're accessing it digitally rather than face to face. But they have no less concerns and worries about that whole process.
I think that they are less likely to want to go to a bank, wait for an appointment, see somebody. I think that people, they want to be serviced outside of their working hours. They want access that suits them at a time that suits them, in a way that suits them. And I think that's one of the considerations in the ways of engaging, because we've been forced to, going back to, we shouldn't just do it the way we've always done it, but now at home, actually, we should be thinking about those future generations. What is it that they want? And as an example, I think that helps me think, that drives me to think about the question is, we went to see a musical and it had no interval. And I was like, oh, why is there no interval? And I read the little magazine or brochure, whatever it's called, and it said because the younger generation are the Netflix audience, and they don't want to sit through that long. They don't want to sit through an audience, through an interview session. They actually have a much smaller attention span, and 90 minutes is their max. And I think it's the same with getting goods and services. They don't want to go and sit, wait for an appointment, take a day off work, have to, be when it's convenient to you. Actually, they want goods and services at their convenience. And I think that's one of the things that's really going to drive differences in the way we engage with our customers as we go into the future.
Absolutely. I think it's probably a sweeping generalisation, and it's probably a little bit out of date, but I was once told that the older generation ask, does it do this and does it do that? And the younger generation say, why doesn't it do that and why doesn't it do the other? And I think there's a far greater demanding audience amongst younger people, and therefore I think we'll be forced anyway to go through that digital journey and speed up the whole decisioning process and put more control in the customer's hands. I think it's quite an interesting sort of look forward, isn't it?
We'll move into TikTok then. Yeah, so a final question. I've seen there's a bunch of questions from the audience, which is great. And if you have any, please pop them in now. So yeah, looking more kind of ahead, like what specific things on the roadmap should we be looking out for? Tim, should we start with you?
Yeah, sure. I mean, I think there are, I guess, one or two things that we already know that are coming down the tracks from the government. The announcement in the budget about 95% guaranteed scheme, I think, is probably, we don't know the detail of the rules yet, and it's interesting that they announced that some of the larger lenders will be ready to lend in a month's time, which is an incredibly short space of time. I launched the Help to Buy guarantee scheme as a lender back when the first scheme was announced by George Osborne, and that took us from July, from a standing start, to December. So to be able to launch something in the space of about a month, 6 weeks, will be quite a challenge in its own right. And if you don't know what the scheme rules are, and I know a large number of lenders will be just waiting to find what the rules are and what they have to do to be able to make it happen. Not just from a systems perspective, but also from a reporting and from a governance perspective. How much do you have to report back in terms of how much you've done, and so that the government knows what commitment they're making around guarantees. And then the other one, obviously, is the Bank of England's guidance that told lenders that they've got 6 months' notice that the possibility of negative interest rates. Now, I know lenders, when they during the credit crunch, hadn't done a rate change for almost a decade, and were concerned about whether their systems would work just to do an ordinary rate change that they've done day in, day out. No lender's ever done negative interest rates. They don't know if their systems will work in a negative interest rate environment. They don't know what their terms and conditions will allow for individual customers. And it's very difficult now to change your terms and conditions unilaterally without the customer's permission. And there'll be a whole load of operational procedures. So those two things coming simultaneously on top of everything else that we just talked about in terms of digitalisation and remote working, must be a real headache at the moment for lenders.
Yeah, I think it is. I read a release. There was a release. I think it's as Tim says, I don't think it's the full release from the Treasury in terms of the way that the scheme will be administered. But I did read the 3 packs that came out last week. So I think it was about 700 pages. So it's a pretty complex scheme, which possibly feels like it's built for larger lenders. So we're giving consideration to it at the moment as to whether we participate in the government scheme, but it's not the only scheme that is out there. So there's the First Home Fund in Scotland, which will launch on the 1st of April, which is specifically targeted at first-time buyers. The Scottish Government have allocated 60 million to that. And there's also a builder-backed scheme as well, which is in the sort of early stages, or I would say mid stages of development, which lenders can participate in as well, which would give access to high LTV. But I think, yeah, possibly the most uncharted territory, if you want, that we're moving into is potentially negative interest rates. I think that's the thing that could have the unintended consequences in many ways. And we've never before experienced negative interest rates in the UK. So it's sort of like customers on tracker rates will benefit to a point. So their rates are likely to fall to the contractual floor of the tracker. So I get that would be a reasonable fiscal stimulus, and I can see the reasons for doing that. Savers are going to find themselves in an environment where it's just really punitive. Their savings rates could actually fall to almost zero, or in fact, and if you look at the German model, there was a depository charge or depository fee from banks and building societies for customers to actually hold money on deposit. Do I think that is going to drive some degree of fiscal stimulus? I don't think so. And you could actually potentially see customers taking their money out of the bank and putting it into cash for smaller balances, and that's not a good outcome for many reasons. And then you've got the banks themselves who hold cash on reserve with the Bank of England in the Bank of England's reserve account, and they at the moment I think are getting 1 basis point. So if that moved to a negative position, then they're going to find themselves being charged for the money that's being deposited, and I don't necessarily think that would drive a fiscal stimulus either. There's actually a school of thought that this could have a completely counter effect on the market, and that if banks felt that their model was being threatened, that they might actually retrench and decide that they were not going to lend in the kind of volumes that they would normally in a negative interest rate environment. And I think we did see aspects of that during the credit crunch. So it's probably moving. Negative interest rates for me is the one where we are really starting to move into uncharted territory, and you'll get a lot of armchair economists out there, probably myself included. So running a household is nothing like running an economy. So I'm probably straying into the realms of being an armchair economist here. But I think, can you have negative interest rates? Yes. Should we have them? That's a decision for someone far smarter than me.
It does feel like it would be hitting the big red button, the final button of last resort. I don't think anybody particularly wants it.
I would agree with that. Yeah.
I think the other thing is just playing catch up, isn't it? So I mentioned earlier that there's a whole load of lenders who haven't got API capability at the moment, and I think that will be crucial going forward. So they'll be wrestling with their API strategies and working through their digital ecosystem. I'm trying to sound like I know what I'm talking about. But I think that will be the thing that changes going forward. So I think rather than having one system that does everything, I think that lenders are increasingly looking at components that are best in class for the bit that it does, and then making sure that they understand how it joins up. And that integration piece and data migration were always the two biggest pieces in the jigsaw, which caused greatest concern and had the greatest risk. So I think that is something that won't be faced into without some sort of fear and trepidation, but it's absolutely critical to the future, and that's why you need people like Barbara who know what they're talking about in terms of managing that process through.
Oh, thank you,
Barbara.
But I don't really have much to add to that because I'm nowhere near an expert in the fields like you are. But I think just from a customer's point of view, and myself being one, I think that the change is so much that actually I wonder because a lot of us bank with the banks of our parents and their parents, and we just followed suit and didn't necessarily shop around, just went with it and took the advice from our parents and did what we needed to do. But with so much changing and having been through so much change, I wonder whether that will be an influencer as well around people making or being forced to make different decisions than they would have done previously, because if banks aren't lending, then you can't just assume the one that you would have gone to will help you. So I think that's all quite interesting. And like you said, I mean, I'm certainly not an economist. The closest I get to it is playing Monopoly and losing badly. But I think it is it's really going to just drive, the people maybe moving back home with their parents, and they probably did that in lockdown because they were lonely. So they've got more used to going back home again, and that maybe takes away the drive to want to go and move somewhere else or leave home, especially with the nervousness around jobs and furloughs and everything. So you can really see it starting to be that domino effect, can't you, of if one goes, then it kind of impacts all over the shop. So it will be interesting to see how customers react as well as lenders react.
In many ways, the customers don't care about the action, it's the impact that it has upon them. So we've been living with something called margin compression now for a few years. So effectively, when the base rate is very low, the whole market gets sort of squashed down. And that has had an impact on the banking system. So I suppose if you were to say that a strong and stable banking system would deliver the kind of environment that customers want, then if negative interest rates in any way undermine that, then is there an argument to say that they're perhaps not the right the right thing to do, because it might actually impact negatively on the customer outcome. I think you're definitely shooting in the right space there, Barbara. Customers will end up perhaps taking actions that they don't want to off the back of that change.
I think you end up with a cocktail of competing pressures, don't you? So if the government are trying to encourage generation buy rather than generation rent, and that's why they've introduced the 95% deal. Well, we know that the Help to Buy guarantee scheme first time around, because it was available to everybody, and didn't do anything to actually support building more houses, just actually pushed house prices up, and therefore puts houses out of reach of the very people you're trying to encourage to buy in the first place. And then if you pile negative interest rates on top, then that makes it very difficult for lenders to make any money, and actually potentially could make some turn some lenders into loss makers and either withdraw from the market completely or just close, which would reduce the supply of mortgages into the marketplace. So they could actually, as Steve says, have the opposite effect. So I think we need to make sure that all these decisions are made in the round rather than in isolation.
Okay, let's move on to questions, and thank you, Tony, about your question about negative interest rates, and I hope we've answered that already. There's one here from Pete Proctor, who says, there's a lot of talk over what customers want and or might like, but not much on how hard it is to make the changes. His view is that this will clog up established financial services and push forward the challenges. So maybe coming to you, Barbara, how difficult do you think it will be for kind of larger companies to deliver this kind of change with pace to ensure that this doesn't happen?
So I think historically, when you're implementing a big change, you allow about 18 months, don't you? Because you need to work out what it is, what are the requirements, what's the design look like, then you need to test it, then you need to make sure everybody understands, and you're 18 months in. And I don't know whether 18 months is, we've got that time, whether we need to start reacting much more quickly. So I think that's going to have a massive change just in terms of the way that those project teams work in big organisations. So going to a more agile approach, going to less risk approach. So, just going for it and not hoping for the best, obviously, because there's a bit more control than that, but going for it, doing a little bit, testing it, releasing it, doing another little bit. So true agile methodology rather than let's get it completely right before we do anything, because I don't think the marketplace will wait for that. I also think that we need to recognise that everybody has different skills. So we need to make sure that when we do this change, you can't just use the people stretched. Everybody's gone through a lot of change lately, so maybe they're not feeling so up for stretching themselves out of their boundaries that they've already got, because we've just done that for the last year across every aspect of our lives. So I think that my other point would be, we need to make sure that we use the right people in the right way. So those underwriters or any of the people in those professions are used in the right way to give their advice, their guidance, looking at what they would recommend, because they're the ones who do the job, but then recognizing there's other skills at play that come in to help them and support them do that. So in my experience, being a change manager, I don't need to understand lending. I mean, obviously it will help, but I need to understand how to help the people that are going through the change. And I think that's really critical that we remember that bit when we start to plan, because it's really easy to have a senior leader that's saying, I want it by Friday, make it happen. But actually, we need to do it right, but we need to support the people to do it right as well. But we need to make sure we continue to be timely. So I think it's a real challenge as we look through the next few months.
I think clarity in terms of what's required as well. So inevitably, everybody's optimistic about what you can get for the money, and the reality is that you don't get as much as you thought you were going to get, and therefore being disciplined in decision making, prioritising and compromising, and working through what you can do in what time frame, I think is critical. And in my experience, lenders haven't been particularly good at that.
And I think as well, like the landscape keeps changing, doesn't it? Like you were talking about earlier with the roadmap, what's coming up, we don't actually 100% know. So if regulations are going to change and some of the things that you measure against or that you've got to conform to are changing, that just throws another spanner in the works. So it's a bit like trying to pin jelly to the wall a little bit, isn't it? Because everything's changing and we're trying to stabilize, a pile of jelly.
Yeah. I'm sure lenders it's not peculiar to lenders, but for sure, trying to push the decision back and decision back and decision back, and I hope you might be able to squeeze some more stuff through, which actually just makes it even more difficult to deliver. And then once you decided, going through scope creep as you try and force changes through in the project, I think it is something that I've seen a lot of, and just need to deliver something as opposed to nothing at all at the end of it.
I think at the outset, you need to acknowledge your strengths and your weaknesses from quite a humble standpoint. So I think there are particularly with not specific to, but particularly with smaller businesses who maybe don't have the breadth of skill set, that there's no room for egos in the boardroom. So the business transformation space is highly complex, which is the first thing, and the FinTech space is even more complex. So it's a really expansive subject. So you need to make sure that you've got the right people in the business supporting that journey from the start. But I think as a lender, and particularly again, but not specific to smaller lenders, the amount of time you take to reach a decision should be directly proportionate to the resource that you have, both in terms of your people and your financial resources. So if you've got vast resources, you can probably afford, you don't want it to happen, but you can probably afford to have a crack at this and fail. It's not going to be catastrophic. Whereas if you're a smaller business with very limited resources, you may actually only get one shot at this. If this is a real, transformation of the way that you do business. So you've got to be super careful before you embark upon that journey. So it's like, I think Abraham Lincoln said, if you're given an hour to cut down a tree, you'll spend the first 50 minutes sharpening the axe. And I quite like that analogy in relation to aspects of business transformation. It's got to be very well planned and thought through.
Absolutely, and I think the other piece is some sort of common accord. So if you're not clear about who wins out on what, you may have a beautifully polished operational process and strong risk controls, but if it's not delivered in a way that the customer can access it, you've got no customers to put it through, and therefore it's making sure that you're clear about what's deliverable and what the priorities is critical.
All right, let's have another question. So we got this one from Charlie Simmons. Maybe coming to you, Stephen. Do you think the industry is doing enough to address security concerns with transacting digitally?
Thanks, Charlie. That's a nice, easy one. I'm not an expert in information security, so that's the first thing that I should say. Do I think that the industry is doing enough? I think there's change coming up when it comes to security. So change in technology can actually drive a different set of requirements for a business. So I'm taking this down a bit of a rabbit warren here, but if you look at quantum computing and what that is going to do to the world in terms of the security requirements that will need to come with that, is going to fundamentally transform everything that we do. So actually, I think the information security world at the moment is probably, it has an element of dynamic nature to it, but it is not highly dynamic. Down the line, it is going to become highly dynamic. So as we start to see more changes in technology creep in, and distributed ledger is another. So at the moment, things happen slowly in our industry, which gives an element of security because it is happening slowly. When things start to happen quickly, that fundamentally changes the landscape. So it's a lot of money moving to places very quickly. And that's something that we need to give a good watch and brief on, because if we get that wrong as an industry, that's a fundamental flaw in what we're doing. So I probably think, in answer to Charlie's question, we're probably just about doing enough at the moment, but there's a lot of change coming down the line, and we need to make sure that the information and data security and everything that we're doing around that is going to be fit for purpose for the roadmap ahead.
I think from a data security perspective, the tender documents I've seen and been involved in, the core baseline infosec requirements have been quite high, and lenders in particular have been very focused on making sure that providers meet fairly exacting infosec requirements. But I'm not a technical expert on that area like Steve, so it could well be that there's more needed. I think caution in implementing stuff is important to make sure you get it right, but equally if the fraudsters and people who are trying to nick your data and money are moving faster than you, then you can't be too cautious, otherwise you find you get caught out. What I've also seen is that there's quite a lot of fraud tools and risk tools available in the marketplace, but when you get back to that prioritization discussion, quite often the more sophisticated tools get parked in exchange for the basic tools, saying that the basic tools are good enough, and at some point they might not be.
I think that's a great point, Tim. It really is. The most sophisticated tools sometimes are the preserve of the larger lenders, so they get the kit that just covers every eventuality, whereas the smaller lenders, you have to settle potentially even on piecing together your solution from a few different places that are at a lower end of the cost spectrum.
The problem is that fraudsters then follow the line of least resistance, and therefore go for the lenders where they suspect that the fraud tools will be less sophisticated.
Yep.
Okay, we do 5 minutes left, so we'll do one more question. For those that we didn't get to, thanks, and we will. We're going to run a series of these events, so we'll try and get to these questions in another session in some way. This one is from Jonathan Bray, who says, do the panel feel the industry generally may have deployed tactical solutions for remote working, e.g. telephones for operation staff, that may need to be unpicked? Anyone have a go?
I think so. I think generally, like Stephen was saying, he moved 85% of his workforce within, what was it, a couple of weeks?
Yep.
So you don't have time, like we've just talked about, to sit there and put a tender out and assess all the responses and what one's going to be best for my business. Just have to do an emergency response. So I think that some things companies would have chosen a solution that has actually fit the purpose, and why change it because they've got bigger things to worry about. But there'll be other solutions that they chose that maybe could be refined or updated. And I also think that in situations like the pandemic that we've had, it's given the opportunity for other firms to come and sell their services and maybe be disruptors and offer stuff people just didn't consider before because they didn't see the need. And I think that those kind of new technologies would also be one of the things that companies start to consider around what do they keep and what do they, because effectively and we took it home, and now we've got an opportunity a year later to say, well, where are the efficiencies? And I guess that's what we've been talking about. So some of that will be efficiencies in systems and providers that we've selected, and others will be efficiencies in the way that we work as people.
Steve, you got some first-hand experience, I guess.
Yeah, I think we made the call that COVID was going to be a long-term issue right from the off. So we kind of doubled down on what we did. So suppose if you stick with that mindset, could we have another pandemic? Yes, it could happen again. Let's hope it doesn't. But it could. So I don't think we would necessarily be quick to unpick certain aspects. So I think we will retain, the digital telephony to give everyone that telephony from their laptop, the voice over IP technology, absolutely. And the virtual desktop, and things like Zoom and Teams to allow us to contact our customers and members in a different medium. So I don't think we would be quick to unpick anything, if I'm honest, on the basis that we don't actually know what the new normal will look like. And then if you've got even just 5% of your grey matter spinning up on the basis that this could happen again, is it worth retaining this in the background? Yeah, it probably is. So yeah, sort of answer to that question, I would say, yeah, we won't be unpicking anything as a business.
I don't know is the honest answer, but I'm suspecting that there will be different levels of response. So there'll be some people that, like the First World War, thought it'd be over by Christmas, and therefore put some sort of short-term tactical solution in, and may need to go back and make it more resilient. And there'll be people like the Scottish who've done a proper job of it, and therefore can be more comfortable in ensuring that it's a more enduring solution.
So we hope we've done a proper job of it. Yeah.
You'd have known by now, wouldn't you?
Yeah.
But I think even if you've got enduring telephony solutions, I think there'll still be operational processes that can be improved.
I think improvement. I think I've probably not answered that question as well as I could have there. So I think Tim and Barbara, indeed, you both alluded to this. I think there's an opportunity to improve, absolutely. But removal of some of the things that we put in it, we have implemented, probably not likely.
I don't see this thing going away anytime soon. I think there are certain lenders who basically said that they're happy now for home working to be the way of the world, and they're even thinking about selling up some of their real estate because they won't need it anymore. There were others at the start who thought as soon as this is back to normal, we'll get everybody back in the office and there'll be no home working again. And I think they may be having to rethink that strategy.
I suppose that's a subject for another episode, isn't it, about commercial lending? If everybody's going to be moving out of their real estate, then what happens there? But yeah, conversation for another day, I guess.
Yeah, that's a good cue. Thank you so much to our panelists, and thanks for tuning in and giving your questions. As mentioned, we'll come back and do some more of these events. And yeah, that's all. Have a great rest of the day, and yeah, see you soon. Thanks again
For having us.